Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Tom Bachrach, the principal at PFH Capital. Tom is an eclectic investor who travels around the world looking for mispriced smaller companies, especially those in markets that a lot of other investors shy away from. He also is willing to invest in sectors that other people shun for various reasons. With all of that as background, I was looking forward to chatting with Tom about the founding inspiration for PFH Capital, the countries and markets he tends to gravitate towards, what it means to see companies with healthy financials, why he is interested in investing in companies with exposure to commodities, and what people are totally missing about coal. And without any further ado, here's my conversation with Tom Bachrach of PFH Capital. Tom, you started PFH Capital back in 2014 and have a track record that dates back to 2015. I'm curious about the founding inspiration for the firm.
Yeah, so back in mid 2015, that's kind of when I started managing funds of a few family members alongside my own. That's kind of where that track record kind of starts. I had a day job up through the end of 2018, and that's when we launched the fund. This was obviously, so it was kind of a little bit of a part-time endeavor in those early days. And so, when you talk about like founding inspiration, right? I mean, that's really what it was. I liked investing. I didn't like my day job. And so I wanted investing to be my day job. And it was as simple as that. So when I felt like I had a combination of experience and kind of starting assets, I made a jump over. And obviously, I mean, what I love about it, I think what really drew me to investing and has made this, frankly, the career that, really I want to do until, I'm kind of toes up out of the office here. I mean, what I really love about it, it's just, I think it's just incredibly intellectually stimulating career. And equally as important to me, just personally, it was one that kind of afforded me full control over my time. That's our most precious resource that was really always my number one priority, was controlling my time. So it's just the perfect balance of keeping your mind exercised but being in control of how you choose to spend your hours, which it turns out, spending a lot of it working too hard anyway. So didn't need someone else to tell me to do that.
And we're going to talk a little bit about the strategy, but I'm just wondering, for someone who's listening to this and thinking about you as an investor, is the strategy the exact same that you were running, when it was a part-time job, now that it's a full-time gig, or has it morphed over did it morph in those 3 years where, from when those 3 years where it was more of a part-time thing?
So it's definitely morphed. And it's been, well, so I think it's always a slow evolutionary process, your development as an investor. Like, I don't think, I think if you're changing your mind too fast, you're doing something wrong. You're not grounded enough. You shouldn't be, changing your entire philosophy every month. At the same time, you should never be static. There should always be like a slow evolution and growth. So it's always changing. So I think part of it was just there was natural growth that would have happened if I did the fund or not. Specific to switching, I'd say kind of full-time, from part-time managing a couple close family members to full-time, and now managing, non-family money, some people that, obviously, I've gotten to know, but aren't immediate family. I mean, I'm more willing to take a wild risk my own money. Less willing, but, probably still willing a bit to do it with close family money. Once you start getting that outside money, I actually think you become, sounds crazy because obviously our portfolio, we take a lot of risk, but you think a lot more about it. It hurts more to lose someone random's money than, your own. And so I think that kind of naturally pushed me down more of a value investor path where I was a little bit more focused on downside risk. Probably pushed me a little bit away from maybe the growth compounder path. I don't think it was anything too extreme, but it's definitely changed, definitely evolved. Like an allocator would probably say, "Oh, well, call it style drift or something," but I call it, learning and changing. I mean, the idea that you're supposed to be the same investor, 10 years later as you were when you started. I think that'd be like a red flag. So I would say that was it. It kind of pushed me more towards the value end, and maybe that would have happened anyway. But um, it's just different when it's your own money versus someone else's. And the more, in a way, disconnected that person is from you, at least for me, the more concerned I became about losing their money, permanently impairing their capital. I'm not talking short-term stuff. I'm talking about the long-term stuff. So.
And in the middle of next year, you're going to hit a 10-year anniversary of, that track record. How would you assess how things have played out relative to your initial vision when the firm was started and when you kind of decided to do this full time?
There's never, I mean, I don't know if maybe I'm not supposed to admit it, but I mean, there's never been like a grand vision really, right?
Mm-hmm.
Like, I mean, for me, it was like, I mean, because I want like a well-attended funeral after a long career doing this and a good record on my tombstone, like that's kind of like the vision. I don't, when we were initially launching, obviously there's a whole bunch of thought process you go through about how you're going to set this up, how you're going to structure this, who you're going to partner with, who you're going to work with. But I'm not a huge believer in 5-year strategic plans and things like that. I think I think most of those things look silly 5 years later, just because, and the key is really just being able to kind of adapt along the way. For me, I think when I'm at my best, I think it's really one day at a time. You wake up, you're looking at an idea or two, you almost certainly reject them. You try to go to bed a little bit smarter. I think if you knock out mostly good days, are not all going to be good. I think if you knock out mostly good days one day at a time, things generally snowball and long-term performance wise, you end up okay. And of course, that's really what keeps you in this career or doesn't. So.
I like that. Take it a day at a time, right? I mean, that's good for anything in life, but given how sporadic markets can be, and I always, when I guest lecture, I always ask the students, who had COVID on their spreadsheet for 2020, right?
Yeah.
And of course, no one raises their hands, right? Because the markets throw you things. So whatever your 5-year plan was in 2019 got upended. So I like that. And so there's so much to dig into regarding your strategy. But I think we should just lay it out there for people. You invest all around the world. Maybe you just give us an overview of the geographies and the market cap spectrums that you focus on primarily.
So it kind of comes down like structural advantage for us. It's, and I think we kind of view it to be twofold. I could probably add a third fold in here, but let's start with the twofold piece. One, we're small. We're small in terms of AUM. Even when we get to a point where we're going to stop raising, frankly, that level where we're still very, very, very small. And that's structurally that's designed, and this doesn't make us unique. There's a million people out there like us, but structurally that's designed to just allow us to basically, play in an area that might be, too illiquid for, or is definitely too illiquid for many of our kind of large fund peers. It's just our investment universe is just a lot bigger. The second kind of structural advantage we have, which I think is somewhat more rare among our small fund peers, is we have some global custody relationships that kind of allow us to ultimately access about 100 markets worldwide. Compared to, say, I don't know, maybe for interactive brokers, maybe you're talking 40. So, that allows us to kind of go more off the beaten path, when we see attractive opportunities there, which isn't always, and so we, that's kind of a structural advantage that there's some periods where maybe we're not really using it that much because we don't see the opportunities, but I know it's going to come in handy long term. Um, and all that said, right? I mean, I could tell you, oh, we're microcap fund, but the reality is, I mean, like if Meta and Microsoft were the two most attractive opportunities to us, out there right now, we'd buy them. It's not, I'm not, religiously, we are flexible ultimately. So I'm not like religiously stuck in this one thing. But yeah, I just think the odds are over time that you're more often than not, you're going to find better long term, 5+ year kind of value opportunities and really lesser followed names, lesser followed kind of corners of the market. So yeah, I mean that kind of sums up those two. The third one I could kind of throw in there. I was talking about kind of the third fold, I guess you could say, of it is that we truly are long term. I I know a lot of people say that, and we could talk more about this later, but we try to structure ourselves truly so we're basically, you know, we don't have investors in this fund who are we have you can go into it. I mean, we put lockups in, we do whatever. We don't have people in this fund who are looking at their quarterly statements and getting overly, upset or excited about it. And frankly, if they do, they're not a fit, and they'll probably find their way out more often than not. But we have some strong filters in advance to keep track of that because I know a lot of guys who are intellectually understand the importance of being long term, but it's a lot easier said than done if you're having a bad year or two and people are starting to kind of you have a lot of short-term hot money kind of investors who are all over you about, why are you doing this? Why are you doing that? And as soon as that person, that investor, decides to start taking these short-term shots to try to make up for the inevitable, bad year, they're kind of dead as a value investor. Like that's it. So you really need to be structured that way and be careful about who your base is.
And with all that as a backdrop, I'm interested in what the portfolio actually looks like, today when it comes to geographies and market cap. Like, what are we talking? Everything's micro. Is it? Do you have like mega caps in there, and like where? What is the U.S. non-U.S. split, if that's even a relevant metric?
So we're probably, and without numbers in front of me, I'd say I'm probably pretty accurate in what I'm giving you. I mean, we're probably 30% kind of US, Canada, UK, Australia, those types of markets. The other, and the other probably, we probably have 10, 20% cash, gold, things like that right now as kind of just liquidity. But fully half the fund is in markets ranging from Peru to Kazakhstan to Poland to unfortunately, we have a uranium miner in Niger. It's been a interesting week there. If you Google the news, that one's been a real long-term roller coaster. So those are types of markets we're in. We don't really. I can't think of it. We don't really have a single large cap right now. We don't really have a single mid cap right now, but we do have a few. We probably have more small caps than micro caps technically if you were to parse them out, but that micro and small cap range is where we really like to play, and it's just because our portfolio is probably a little bit more, I mean, not probably, it is, it's somewhat energy heavy right now. There tend to be a bit more interesting players in that area, I think, in the small cap range to micro cap.
Sure.
If we weren't so energy heavy, we'd probably be a little bit more micro cap heavy. So like I said, there's no, we can literally do whatever we want, so I mean, we've completely flexible kind of mandate, but it's that's kind of, typically speaking, I find it hard to believe we're going to have much outside micro caps or small caps at any given moment. And right now that number is really zero outside those.
If I think about an advantage that you have, right, it must be to some degree in sourcing these companies. How do you find companies in Peru? How do you find companies in Poland and Kazakhstan? Maybe you can talk a little bit about that sourcing mechanism and When you do find something interesting, what do you do with it? Does it go on a watch list? Do you like build a model and so you follow it over time? Just maybe give me a sense of like how that pipeline develops over time.
I've never been satisfied with my answer to that question. I don't think today is going to be any different. It's such an organic process, and like a lot of it is you start running down these rabbit holes, and by the time you find a name, you don't even remember precisely what got you there. But I can tell you like a few different mechanisms we use. I mean, one, right off the bat, one of the first ways we find good ideas is we have a lot of other smart, interesting investors that we do regular Zoom calls with, and they tell us what they're looking at, and we tell them what we're looking at, and um, and so there's a natural exchange of ideas there. And it's not just to get other people's ideas; it's to share what you're looking at with them because one of the best ways to do diligence an idea that you think is really attractive and perhaps you've entered is to talk to a lot of people about it and see who comes back and pokes holes and what holes they poke, and maybe some comes back and changes your mind or says, "Hey, you idiot, you missed this major glaring issue." So that's honestly, I mean, probably half the ideas almost really do come from just exchanging ideas with others, and we know they're smart people, and they say, "Look at this, look at that." I mean, we reject the vast majority of everything. I mean, last year we really had two new positions over the course of the year. I mean, like we had like 10 to 20 positions, and I think in a normal year, maybe we're going to turn over like a quarter of the portfolio max. So we move very slowly. We reject most things. We reject a lot of things, frankly, for flimsy reasons. There's a lot of gut in it. I'm not afraid to have a really quick filter because I don't want to waste time going down the wrong roads. I'd say the idea that we find, or the way that we find ideas that is apart from that. So that's kind of exchanging ideas with others. The way we stumble on them on their own I mean, there's one I'm probably not going to talk about, but it's a new position for us this year. You know, Someone forwards me an idea and it's Hong Kong based, and I'm like, wow, this is cheap, but I find a problem with it. Someone else forwards me something that's Hong Kong based. I go, oh my goodness, this is cheap, but I don't like it and I reject it. But at a certain point, you go, oh my goodness, the Hong Kong market is cheap. It is cheap for obvious geopolitical reasons.
Yeah.
And I can come up with the bearish arguments against China as well and all that. But you're seeing these things trading at 1 to 2 times earnings and negative enterprise values and stuff like that. And it makes you think, I should take a look. And so you dive in the market, you screen it out, you narrow it down to, basically, out of, say out of 1,000, you narrow it down to the 25 or 30 things that you think appears to superficially have the hallmarks what you're looking for. And you just start digging through them until you find one. So that's one way we do it. I had the same thing happen years ago in Poland, kept finding interesting things there for cheap. Kept looking at Poland. Then when I kept looking at Poland, eventually I had my analyst there, at the time reached out and was looking to work together. And now I have a guy over there full time. And, so that's a market that, it all starts with you're saying, hey, from macro top level down, this market's cheap. I'm seeing incredibly interesting stuff here. I'm going to go through it. I'd say that's really where a lot of the other half of the ideas come from. But yeah, it's a rabbit hole. Sometimes you're just talking to a company that you're super interested in, and then deep into the process, maybe you're due diligencing them. You're talking to a competitor, and you go, "Oh my God, I like their competitor better." And sometimes they're private, and you go, guess I'm out of this completely. And sometimes they're public, and you go, actually, I'm going to buy these guys. So that's a long answer to your question, but it's I think you got to be just hungry and constantly looking, but I think you also have to. People talk a lot about errors of commission, errors of omission. In my mind, I am extremely, extremely comfortable with errors of omission. I can miss a million NVIDIAs and not lose any sleep. I'm more focused in on the commission side, and I I'm always conscious of I want to be able to give a lot of things quick looks, be able to filter them very quickly so that I save most of my time for deep diving the ones that are really of interest.
And you mentioned that you own 10 to 20 stocks typically. I'm interested in how you settled in on that number. And you talked about evolution as an investor. Has that evolved over time?
I don't think that's evolved too much for me over time. I think I've skewed maybe towards one end of the extreme or the other at times in terms of what I thought made sense. But I think I've always kind of been in the zone I'm in is kind of the 10 to 20 range. I so my attitude towards it is basically this. I mean, I think once you're over 20 positions, you're almost certainly into your second and third tier ideas. Um, Plus, on top of that, and I think this is something a lot of people maybe don't think about who are outside the career, there's like a certain amount of maintenance work with a holding. Some holdings are high maintenance, some are lower, but they're going to report quarterly. News is going to come out. There's just a certain amount of maintenance work, and so if I have 30 holdings to kind of maintain, that's a lot less time than I have to be out there searching for new investments. And
Yep.
so I think 20 is kind of the extreme of where I would ever like to be on that one end. And by the way, just to kind of touch base on that again, right? Like that time that we spend looking for new ideas, it's not just there's obvious reasons we do that. We're always looking for good ideas, but fundamentally, that's the opportunity cost in the market that we're holding our current holdings against. So, if I find a bunch of interesting opportunities that are out there, you know, at a certain point, if they get more interesting in certain things in the portfolio, they need to go. And if I'm spending all my time just following my own stocks and not enough time looking for new stuff, I'm really not putting the opportunity cost bar up in the right way, to appraise my current portfolio. So on the flip side of that, that was 20 positions. Under 10 positions, there are a lot of smart people out there. Who will be going on 4, 5, 6, 7, 8 positions. Just for me personally, that feels overconfident. It requires a level. This is personal, right? Like I think it works for other people. It just requires a level of certainty in like your predictions that I frankly don't have. Maybe I did in my younger days, and I think I was probably flawed. As I've gotten older, you appreciate the uncertainty of things just way, way more, and so you're always going to have a few positions moving against you. Actually, in my career, I tend to find that I tend to have several moving against me, and then they all suddenly going up at the same time, and for some reason they never seem to be netting each other out, right? So when those things are moving against you in the short term, how you respond is a big piece of what makes you a good investor or not. And my feeling is it's easier to keep your cool with a few extra positions, a little bit smaller average position size, basically.
And you mentioned position sizing. What does that typically look like? Do you have established like starter positions or full positions? Do you let things drift? Do you rebalance? Maybe just talk about how you've approached position sizing.
Yeah, so we're willing to risk between, and we've been pretty consistent about this over the years. So I mean, if you think 10 to 20 positions, that would be a full portfolio. You're talking, 10% per holding on one end, 5% on the other. Now, in reality, it'll never be that because when we talk about position sizing, this is what we go in them at. If they do well, they might become a much larger position. But we're willing to risk in an initial position size. We're willing to risk between 5 and 10% of our capital in a new position. We're not adding above 10%. If it's going to go above there, it's going to have to do it on its own through its own relative performance. We have the occasional exception, I'd say, in a portfolio where maybe at any given moment we might have one where we did a 2.5% size position. This would be some case where we just think the skew has incredibly high upside, but very obvious zero potential of downside, and we don't feel comfortable putting 5%, but we do like the exposure. So like I mean the way I would kind of in terms of how we decide though what to put in those categories. because that's the next logical question, right? You said 5 to 10%. Well, why do you do 5? Why do you do 10? So, I mean, there's a really two big questions we kind of, have to kind of, once we've decided we want to own something, there's two big questions we have to answer. The first one is, what's the discount rate, the required rate of return? And for us, like a lower rate, higher valuation, that expresses a higher degree of confidence in what the business is, kind of returns on capital will be going forward. There's certain businesses where we go, yeah, these guys are going to grind out great returns on capital. And there's certain ones where we go, we think they can, but we see a lot of scenarios where they don't. So that's going to play a big role in what the parameters are in terms of basically our required return. And the second question is the position size. And that's really, to me, that's pretty much all about zero potential. It doesn't necessarily mean I have more conviction in a 10% position than a 5%. What it means is that, the businesses with significant leverage, financial or operating, businesses that are pre-revenue, they're in a risky jurisdiction. These all have, zero risk, and we're just not really interested in watching a 10% position go to zero. So a 10% position, the ones that are on that risky end will be 5, and we will go 7.5 when we find something a little bit in the middle. A 10% position for us, it needs to check all the boxes. Good balance sheet, stable profitability, safe jurisdiction, solid management. A 10% position, we don't think, if we're wrong, really hurts us all that much. A 5% position, we think, if we're wrong, it could hurt us a bit. So that's really the fundamental difference in position sizing.
I think it's probably a good time to dig into the companies that you're attracted to. One of the things you look for is insider alignment. We haven't really talked about management yet in any degree or any depth. What does that typically look like in practice when you see that alignment?
So in terms of how we measure the alignment, basically what I would say is like, fundamentally, like the thing we're looking at is really what I would call the comp to equity ownership ratio, right? So like there are very few people in a company which control its destiny, right? When I say control the destiny, I mean they set culture. They decide how to balance, return on capital against growth opportunities. We're talking to CEO, chairman, maybe there's an influential officer, board member, outside owner. But it's rare you're going to find more than 3 people who are really directing a company. So like what we want to do is we want to basically identify who those critical people are. It's usually pretty obvious. I mean, the CEO is going to be one, right? Sure. And basically we want to say, what's the market value of their equity that they own? What's their compensation? If you're paid $1 million a year and you own $100 million of equity, your incentives are pretty fairly well aligned with ours as a minority investor. And I could flip that, right? Let's say you get 10 million a year in comp and you own 100,000 in equities, so now instead of owning 100 times your comp in equity, you own 1/100th. I mean, our alignment in that case is basically 0. So that's, in terms of alignment, that ratio kind of equity ownership to comp, that's absolutely the initial one we go to. Of course, there's like, as you go through these things, there's a little nuances and things you can look into, but to me, that's the bedrock one. And I really do prefer just old-fashioned share ownership to stock options and all that, because I mean, like if I own shares, I'm long term. If you own stock options that expire in a year, our time horizons aren't really necessarily all that well aligned. You can make this, you probably, or you're not probably, you are incentivized to make some short-term decisions that could come back to, haunt us later. You could be some guy like AIG in, 2006 or 7, just, underwriting every single risk in the world, knowing that it's going to come back and blow up, after your options expired. So there are all these other aspects, but I do prefer old-fashioned. I want them to own the same exact shares we own, so.
And another must for a portfolio company of yours is what you call healthy financials. Is that mainly a reference to the balance sheet? Is that an income statement, return on capital reference? What does a company with healthy financials look like to you?
So it really does. I mean, the balance sheet's the most important factor. I mean, if you're going to pick one, it's always going to start from the balance sheet. Again, of course, there's going to be a lot of nuance in this, but with the balance sheet, we're looking at kind of some simple things like leverage ratios, current ratios, but also we're looking, what's the general quality, like the tangibleness, basically of the assets there, right? Not all assets are created equal. I mean, that's pretty obvious, right? But I mean, most obviously goodwill, maybe less obviously things like like contract assets, any other kind of risky receivables that are held out there but aren't really worth what they say they are. So we're looking both at these top-down ratios, but we're also, to the extent we can, trying to understand kind of the context behind the balance sheet and the real value in those assets. There are certain types of businesses, obviously, where there's so much leverage and the value of the assets are so opaque. Most notably, I'm talking about banks, right? But all sorts of financials would fall in this category. Serial acquirers can fall into this category because, they've stacked a bunch of, intangibles and things in their balance sheet, but you don't really, time will tell if those have added value or not. So we focus not just on the ratios, but we're focusing on how obvious is the value there. So and I kind of mentioned the whole, when I kind of mentioned the idea of the context behind a balance sheet. I mean, it's if your business has a lot of operating leverage or is subject to wild commodity swings and prices and things like that, we really don't want to see financial leverage added on top of that. You already have leverage in other ways, and we don't need to see it. If your business doesn't, we're comfortable with a little bit of financial leverage, but I never like to see too much most of all, because I think it's reflective of an overconfidence and maybe short-sightedness in management teams usually. I know there are exceptions to this stuff, but I always kind of become immediately impressed when I see management teams that will, kind of tell a lot of the outside guys, including me sometimes, who want buybacks to chill out and let them make sure their balance sheet's a little safer before they embark on that mission. I think it speaks highly of them. What we didn't talk about, I guess, is, we talked about the balance sheet. I do think that's primary, but profitability backed by free cash flow. That's obviously also incredibly important because, if you don't have that, good balance sheet can go bad real quickly. So obviously that's the other half of what we're looking for, but that's usually covered because, you're a value investor. You don't like overpaying for companies. Well, companies bleeding cash and money and losing money are, they're worth zero. So, so you usually filter them out through other mechanisms in a way. So.
And would you say that you're more of an NAV or some of the parts style investor where you're looking for, the margin of safeties and the asset value as opposed to the, kind of the growth potential or the cash flow generating potential? Maybe talk about how valuation fits into the, the healthy financials focus.
So I'm not, I would say the answer, it's always, it depends, right? But I would say as a general rule, I'm not a sum of the parts guy. These are all things that, I want to check off as like a precondition. Like, okay, like, am I willing to buy this? Well, I might, if the balance sheet's bad enough, I might not even want to do the work on it, frankly, because I'm like, no matter how confident I get in this, they're still set up where if one thing goes bad, they're done. And guess what? Like you said, like, who had COVID on their bingo cards in 2020? I mean, these things happen. So to me, it's more of a checklist to make sure that their balance sheets or financials are healthy. Well, by the time I'm valuing the business, I mean, I'm valuing that as more often than not. I mean, I'm valuing it as a going concern business, right? I'm looking at, you know, basically all the fundamentals, right? I mean, one, I want to know, okay, well, and you have to pick a type, right? Because valuating a software business and a coal mine are really two very different things. But fundamentally, you're saying, you know, what do they offer? How do they compare against their competitors? How well aligned is the management? Um, how have they shown themselves to be in terms of kind of capital allocation skills in the past? How confident I mean, this is like the old Buffett rule. If the market shut down for 10 years, how confident am I that they'd be around and doing better, even if they didn't live up to my wildest dreams? How much of a growth runway do they have left? Um, predicting, obviously a better business will be able to take the best businesses, the best returns on the face of the planet will always be a business that has a massive growth way in front of it and generating free cash flows and can reinvest those free cash flows without dilution at high rates of return into that growth. They're tough to find. They're tough to, you're starting to make these big predictions about the future, but when you find them, I mean, fundamentally, you want to come up with a fair value PE. I mean, it's the fundamental questions you're asking yourself is, how much of this can they reinvest every year and at what rate of return? I mean, that's to me, like those are the two factors that drive a PE fair value. We spend a lot of time just really understanding the cash flows, understanding what their plan is to do with them, what's the opportunity to do with them, and we're going to work an evaluation on that on a going concern. I don't love the sum of parts type stuff because I think more often than not, sum of parts is used to justify something that if you just looked at the business holistically, you wouldn't have done. Now, sum of parts becomes appropriate in certain things, right? Like if you have two different business segments and you're trying to sell one off, well, yeah, I can come up with an estimate of what I think you're going to sell that for and essentially take it out and value the stub business and factor it in. So, it has that value there. But if they're not going to do that, the sum of the parts just is often just used as maybe as a way to justify buying a conglomerate that doesn't really have any grand vision and is going to have middling returns long term. So, yeah, I don't know if that makes sense, but yeah, I do. I like businesses that have a clear vision, a clear focus, and you value them off the potential of that clear vision and focus more often than not.
We've already talked about the fact that you're willing to go into countries that other people may not be willing to go into. For example, you discussed in a recent letter a company that owns gold mines in Russia and Kazakhstan. I'm interested in what attracts you to a situation like that, like for example, a gold miner that's in Russia and Kazakhstan.
So yeah, I mean, the answer is valuation. I mean, it really is valuation. And we never buy things just because they're cheap. I guess if it was an active liquidation, it was incredibly cheap. Maybe there's a play in there or something, but we don't want, there's, you got like 100,000 things trading out there in the world. And your goal is to get something that's worth owning and cheap, not just cheap and not just something that's high quality at any price. Right. So we find that, you can often, that it's very, very hard in a market like the US to get something that's both high quality and cheap. It's borderline impossible. I mean, it can be done, I guess, at the nano cap, micro cap level, you find the right thing. But it's very tough to do. So you go to some of these other countries, especially some of these countries that maybe people have a little bit of hair on them. You can find these things, and then you can kind of manage the risk a bit, not entirely, but a bit at the portfolio level by making sure you spread around enough different countries because anything can go wrong in some of these countries we look at. The holding you mentioned, it's good. It's a good case in point, right? So that's polymetal. And I remember you told me to make sure I disclose. So we are long shares in polymetal. I had non-investment advice, et cetera, et cetera. We, but it's an interesting case study, right? This was one where, so Polymetal, it was a, world-class gold producer, 8 mines in Russia, 2 in Kazakhstan. Russia invades in 2022, price drops 90% within 3 weeks, which is luckily when we discovered it. If I discovered it a week earlier, we probably would have, taken the last third of those losses ourselves. Basically, at this point, it's trading at a hair over 1x 2021 earnings. That's where it's priced. Which, gold miners, world-class, top 10 producers in the world that have good reputations, like they don't typically sell there. And of course, it was, a lot of that drop's justified, right? I mean, but at the time you're looking at it and you're going, okay, well, if Russia confiscates, there's no indication they were at the time, but if Russia confiscated all 8 of the mines in Russia, they still own the 2 mines in Kazakhstan. That's 30 to 40% of production. And so you're paying a few times earnings, not one time. I was comfortable with that downside. Now there's an additional downside because you're taking a risk in Kazakhstan now, right? But we just felt like it was pretty well set up, obviously these are the prototypical 5% positions, right? Because I could paint the zero scenarios. And one of the things that kind of gave us confidence in this one, and this is something I look for a lot, when you're going into markets where you have to ask yourself, you're like, okay, I'm a tourist in this market. I might not be quite a tourist anymore in Kazakhstan because we focus enough on it, but I basically am, and so you have to think, what do I know that the other doesn't, or why are these people selling, or this or that? You really want to be able to understand where all that selling pressure is coming from. And in this case, we certainly felt like we understood the perspective of the sellers. For one, there were a lot of people who were just going, oh my goodness, like this is a mammoth risk. We're going to lose this thing's going to go to zero. It's going to get all its mines stolen in Russia. Maybe Russia invades Kazakhstan, takes the L2. I don't know. They come up with all that. But even more so, a lot of selling was just non-fundamental. Yep. People weren't doing the work. They were just selling. Entities like Norway's Sovereign Wealth Fund, they were dumping Polymetal, kind of support Ukraine, right? They weren't doing analysis. They weren't looking at the price or anything. I felt it was a silly way to punish Russia, to sell them your assets for 10 cents on the dollar. It felt a little bit to me like you're rewarding them. And so we didn't really agree with their reasoning, even their moral reasoning for selling. But it gave me an idea that, okay, this is cheap for non-fundamental reasons. This has gone way too far. The other thing with Polymetal I mentioned, like we don't just want to own stuff because they're cheap. We want to own them because they're quality. Polymetal had a reputation. I think that was pretty strong by that time. They were a Jersey company. They were listed in the London Stock Exchange, well-regarded management. I've basically come to really, really appreciate their management watching this through. I think their CEO is one of the best ones I've seen. I think he's absolutely phenomenal. I think he makes the right decisions. I think he cares about the minority investors. I think he communicates clearly. It's just, I think he's been thrown into an incredibly difficult position. I think he's managed it incredibly well. So it was like, we weren't just buying a cheap business. We were buying a cheap quality business, good assets, good management, good historical ROE and cash flow. And then you added this another layer on top with this one, right? Like it was selling for cheap, right? As gold was suddenly getting and continues to get incredibly interesting in the macro sense. And we're starting to see what's happening there, and I can go down a crazy gold road with you too if you want later. But we're 2 years in that investment now. I mean, the management's done an incredible job navigating the sanctions, the counter sanctions. They re-domiciled from UK to a neutral jurisdiction, that's Kazakhstan. They just recently sold off all the Russian assets a couple of weeks ago to wipe out all the debt, walk away with a little bit of cash. They've doubled in share price, but honestly, I still think they're somewhere between, well undervalued, and if you're a wild gold bull, they're incredibly undervalued. It just depends on where you want to put gold prices. Ultimately, it's a funny reverse the thesis is kind of almost a little ridiculous because you were basically like, yeah, I'm going to get like a bump when they move from London to Kazakhstan, which is like an insane premise, but happened. And then you go, okay, once they divest all the Russian assets, add a few more assets in Central Asia to size back up, they're going to come back to London and get another bump, basically. And so I think I think I can see the path forward, but that's these things aren't without risk. I think, I mean, that's an understatement, right? Um, I think get, you got to be able to tick all the boxes. Great valuation, great business, great everything. And the risk is this geopolitical risk. And geopolitical risk, I always felt I could manage a bit at the portfolio level. Just be mindful of how much you have in any one region. You know, now ask me in 5, 10 years how I feel about that, because obviously, I have a uranium miner in Niger, and they're having a rough week, so it does cut both ways. But yeah, that's the whole thing. Again, we're long polymetal, so I'm not I have a bias there, shall we say?
As it becomes pretty clear listening to you talk about some of your holdings, commodities are a common theme in your portfolio. You just mentioned their uranium mine. I've typically stayed away from companies that are price takers because the external market could have such a large impact on their financials. What is your general approach to investing in commodity exposed companies?
Well, so one, I think a lot more companies are price takers than admit. Um, and yeah, I mean, in the end of the day, right, there's a supply and demand function, and a lot of this stuff falls out of people's control. Every software business says, oh, we're critical and this and that and blah, blah, blah. But I mean, the fact is, every software product I use, I have competitors calling me to, pitch their stuff. And when the other one tries to raise prices on me, I say, oh, okay, that's fine. I can just switch. And then they give me the same pricing every year. So I think I think those arguments maybe get taken a little bit too far sometimes. I basically, I don't think, like, fundamentally, right? If you're looking at commodity, it's all about the capital cycle, in essence, and when demand growth is outpacing supply growth, being a price taker on a supply side isn't such a bad thing. I mean, it's kind of a great thing, right? And vice versa. So I think with commodities, it's probably, you have to have a little bit more of a macro view, but there are certain cases where they become so obvious. You're like, the demand isn't going anywhere. It's going to stay stable or go up. And you can look and see the supply is dropping off a cliff. And so I think in the situations where I don't mind taking on that commodity exposure, if one, they have a good balance sheet, because commodities can do anything short term. I mean, ask anyone about what oil did in 2020. And if you have a bad balance sheet, doesn't matter how good anything is, you get wiped out quickly. So one, you got to watch that, and two, I don't like. I want to see them in the bottom, ideally in the bottom half of the industry cost curve. If you don't have an over levered balance sheet and you're competitive on the cost side, you're not really going to get put out of business. Your profits are going to decline. They're going to decline. It's going to thin out the herd a bit. And as long as the demand for your product is there still, so you need to have a view on that, you're going to get a nice rebound. And so, do I think commodity businesses should be priced like, Amazon or these higher quality compounders? Of course not. No, they don't have, like a natural moat, but I still think they can be the most persuasive, investments on the market at the right price. I mean, obviously I have a view as well about inflation risk right now, and not all commodities are created equal on that. I think people just think, oh, commodities will protect you against that. I don't think that's necessarily true, but certainly the energy commodities historically have very well, and for kind of obvious reasons. So, it's kind of the thing that I've seen in the market that's just been kind of incredible to me in recent years is that right as I think inflation risk, and obviously we've already seen a wave of inflation. I don't think we're done with that. Right as that inflation risk is, I think, coming out and almost it's a historically high, I think, the forward inflation risk. The best deal in the market you're being offered are like fossil fuel securities and things like that, which, check them during any inflationary period, they kill it. So I think there's a little bit of an opportunity of a generation, which has kind of sucked me into that space in a way that, because I did, I mean, if we went back and talked to me 5, 6 years ago, I would have been making the same price taker arguments and this and that. And it's just, this is a direction I've evolved in, hopefully for good reasons and not because I've lost my mind. Well, but time will tell. So.
So you talk about the capital cycle. So that's part of investing in commodities is knowing when to buy and when to sell. So we haven't talked much about sell discipline yet. You obviously buy things pretty cheaply, and maybe talk a little bit about what causes you to sell something. And if you want to talk about, what would make you sell one of these commodity stocks, that would, maybe give people a sense of, real life sell discipline.
Yeah. So just as a general concept, sell discipline. I mean, I have a rough idea of where I want to sell something, right? I essentially, I have a higher required return from a buy price, and then I have a much lower one for my sell price, or maybe call it fair value, because I don't necessarily have to sell at that price, right? And the gap in between, of course, that's margin of safety, and I like to run that gap pretty wide. Both to be conservative and also just because, I'm not an overly certain guy. I have my views, but I've been wrong enough in my life to know I need some downside protection on some of these things. Fundamentally, I think selling, it's all about opportunity cost. I mean, I think that's what it's about, right? So like when I talk about a sell price or a fair value, I'm talking about the general area where the attractiveness of that specific investment, doesn't necessarily, probably doesn't exceed like the alternative of holding, say, short-term treasuries, right? Both in the interest they earn, but maybe even more importantly in the implicit kind of optionality. I can quickly redeploy them. They're not likely to get absolutely bombed out, right? If the market goes nuts, and I can quickly redeploy them into attractive opportunities to come along, right? So fundamentally, like once something gets near that fair value for me, I have to seriously be looking at, okay, do I want to be holding this instead of, say, short-term treasuries, right? But I don't, you don't need to hold to a sell price or a fair value, right? Like I could drop a position well short just because I find something else that's more attractive, and I just there's a specific type of exposure. Say I'm in an oil producer and they've come up a little bit, but I still think they're too cheap. But I see someone else come along who I think is way more attractive, and I don't want to buy both because I don't want my oil exposure to go through the roof. And so maybe I do some selling into one to move into the other. It's and I'll say this too: you don't have to sell just because it hits fair value. I would say this is more true of the less commodity side of my portfolio. This would be true more of the classical compounders. This podcast titled after them, right? These are your classic kind of long-term, high ROE, high growth compounders. There are some that I've held for a long time, and I just think they're so well run, and I get nervous sometimes when they approach fair value because I'm like, I might have to sell this, right? And luckily they usually either take a dip or they report and the results are through the roof and you get to mark them up again. So you get to move them away. But these numbers are they're never that precise. So they're there, and you should have a bit of discipline about how you look at them, and you should be careful about evolving the thesis just because you don't want to sell something. But you don't need to be in a panic to dump something because it's hit a number you calculate in a spreadsheet. I think that there's some art behind it there as well.
I'm curious how philosophically uranium mine, a gold producer, I know you've owned some coal. How do those fit in the same portfolio as a typical compounder? I'm just trying to get into your brain and how you, look at, I guess, the quality price trade-off, and what pushes you in either direction.
So, it's I have different answers for all this. So you can mention too, like uranium and coal, like, our coal exposure is much higher than our uranium exposure. And I think coal is actually maybe the more one to answer the question with. With uranium, there's been a story around for years about this idea of, that there was going to be a supply crunch at some point because prices were just too low for too long. The market's a very funky market with a very funky history. And in my mind, I've consistently viewed it as truly the energy of the future, and that at some point people were going to realize that no, we don't need 400 some reactors in the world. We need a couple thousand, and that the price was going to go bonkers when that happened. So I was always interested in uranium if I could find, the right holding at the right price, which we did back in the day with Global Atomic, and that's done well over the long term. Just had a rough year for geopolitical reasons. But I'll be honest with you, the uranium story is much better told, it's much better loved. I have a lot more trouble finding value in that space, even though I kind of buy the bull story. I prefer to get the bull story kind of for free. I don't want to pay for it. I want it to be like I do okay if it doesn't materialize, and I do amazing if it does. And that's tricky with uranium, and that's particularly become tricky in the last year or two because the price has started, well, not started, but it's moved a lot. It was 20 something when we first got interested in it, and spot price got up near 100. I would argue that that was never real because the long-term pricing is more important, and that was around 70 or something. But coal though is coal. So coal's 20% of our portfolio exposure today. I mean, it's a big thing in there. You asked the question of like, how do I square that away with kind of the compounders in the portfolio? And there's actually a lot of different ways I could answer that. But I'll be honest with you, I think coal is a compounder. And I think, and I've seen other people start to make these arguments. There is like a kind of coal community out there that has probably been saying this for a while, but I think it's kind of a compounder in the same sense, and not the same, but in a similar sense as say tobacco was a few decades ago. I think that, fundamentally, if you think about it, so I'll give you kind of the rundown on coal a little bit for a second here, right? I'll give you a few broad points, and then I think it'll make sense why I would call some of these coal holdings like a compounder, right? So for one, I think demand for coal, I know demand for coal equities was kind of artificially depressed by ESG policies. I think some of those are starting to wane off here, but it is not, no one's running back into coal who divested it, as far as I can tell yet.
True.
As I said earlier, I like non-fundamental price action. Like you're selling coal because you think it's evil. That no one's done a discounted cash flow. No one's done anything. It's gone. And actually, I've talked to a lot of people who have divested, and they don't even buy their own arguments. They just say, "Hey, well, this university is going to pull their funds if we don't divest it. So, I got to keep my AUM and my fees." So I mean, it's like when you're seeking out the counterpoint, they don't even try to argue it to you. So that of course was really interesting. I mean, it got to the point where there were people divesting met coal, and for anyone who's not familiar, right? Met coal is used to make virgin steel, which you need for things like solar, wind, all the renewables that they want to replace coal. Thermal coal is, of course, burned in power plants, emits CO2. And so if they were divesting thermal coal, I get it. But there were people met coal was getting sold down. And I've seen more than a few instances. I vividly remember being on a ski trip and sitting in a hot tub next to a ESG advisor guy, and he had no idea like what the difference was between thermal and met. And I thought, okay, well, that's coal 101 type stuff. So that's one. It's just the fact they artificially got depressed. Two, there's a market perception that demand for coal. So even if you aren't selling for ESG reasons, there's a market perception that demand for coal is going to rapidly decline. It's going away. And I disagree, and I think the data is abundantly clear on it. So the argument for met coal used to make virgin steel, that one's kind of clear why they're going to need that for a long time. But even thermal coal, you're burning power plants, the narrative that it's going away is not backed up by historical facts, and it's not backed up by the actions of today. I mean, if you look at the two big drivers of coal demand when push comes to shove, is China and India. They're both increasing their coal fleets by more than 25% by 2030. So they're actively building new and expanding. And this is where really the vast majority of the demand's coming from. It basically takes about 3 seconds of analysis to realize, like, you're not going to diminish coal demand without those two countries, leading the way, basically. We've already kind of done it a lot in the US because we have low natural gas prices. The fact is like, if you look at it, if you take primary energy consumption, about a quarter of it today is fulfilled by coal. Do you know what it was in the 1970s? About a quarter. 80s, about a quarter. 90s, about a quarter. 2000s, about a quarter. The consistency is remarkable. I can show you the years where it was 23 or 28%. It's generally speaking about a quarter. So I think there was this breakage. The narrative that it's going away fast is essentially gone. And I mean, I'll leave you with one other statistic on this point, right? Like, so 1997, the Kyoto Protocol, right? It started to deal with global warming, so the percentage of primary energy coming from fossil fuels as a whole, we're not talking just coal, we're talking natural gas and oil. It's essentially been held flat since 1997. It's maybe even down a couple percent from like 80 something to 80 something. The fact is we're burning 55% more of them in absolute terms because developing countries around the world want to get the Western living standards, and that's the mechanism there. And so I'm not making this to justify it or say it's good or say, I'm not saying global warming isn't real. I'm not making any of these arguments. I'm just saying I don't think that the countries around the world are going to make a meaningful sacrifice to their economic livelihoods to keep the earth from warming by a couple degrees. I think it's, as an investor, coldly looking at it. And this is the last point, right? And then I'll kind of get into the compounder aspect of it, right? So we're talking about artificial selling of shares, non-fundamental reasons. We're talking about understating demand, even for thermal coal. Well, future supply is completely constrained right now, particularly in the met coal space. There's little new money that comes into the space. The banks are basically told to stay away. Meanwhile, these things are generating massive cash flows the last couple of years, making high margins. So in a capital cycle, what should happen in that case? Well, in a capital cycle, these guys should start reinvesting those cash flows, even if there's not new money pouring into the space, which we would expect. They should, at the minimum, be reinvesting their own cash flows in these super high IRR projects at the current pricing, especially for met coal. Thermal coal's taken a beating because of 2 warm winters lately, but they're still making decent money. That's what should happen. Well, that's not what's happening right now, because when you're super cheap and you have low price multiples, you attract a bunch of value investors like myself as shareholders. And we come in and we tell you, no, your hurdle rate is this incredibly high hurdle rate to do new investments. We want return of capital, specifically buybacks. So we're going to suck all this cash out. You're not going to expand and add new supply. And so they basically diminish the supply of securities on the market. They're not adding more supply of coal, right? And basically the only solution is to ultimately re-rate these things high enough, basically, that some of us value guys start to sell to some more growthy capital. And I just don't see any method for this to happen quickly. And what does that mean? Well, that means that they get tons of cash flow to rebuy their shares that trade at 2, 3, 4 times earnings. So in other words, they're producing an incredible high return ROE by buying back their own shares. and with incredible amounts of cash flow. And that's a compounder. A compounder you don't need to grow revenue to be a compounder. You need to have incredibly attractive opportunities to reinvest into that grows per share earnings. And that's exactly what they have right now. So I coal, and by the way, I'll add one more thing on this. The best capital allocation I have seen in the market across the board is in the coal industry now, because every single one of these management teams has basically been forced to, has a value investor showing up and handing them the outsiders and making them read it cover to cover and telling them like, this is what you have to do. So I absolutely, I think that's, like I said, I mentioned this before. A lot of people think of oil and gold inflationary environments. Coal's got the best record. You go back in time, coal's the best record, right? You're talking about little chunks of easy to store energy, right? Governments can't debase the value of that energy. So one of the last things consumer cut in hard times is energy, right? And so you got to keep your house warm, got to keep your car charged, right? If you're going to EVs, right? And make no mistake, the world's largest EV market, China, is fueled first and foremost by coal. I mean, like they're charging their cars 60, 70% of that's coming off coal, which is kind of a wild thing if you think about it, right? If you believe we're entering one of these inflationary eras going forward, and as what I said before, it is absolutely remarkable that you find the cheapest stocks with, in my opinion, the best compounder opportunities in that space. And so to kind of go back to that original question, how do I put these things next to each other? Well, on one hand, I could answer and go, well, like, I think inflation risk is heightened. I think they have a place, but in a much more true measure, they fit right next to my other compounders. And just for, I think for reasons, I think people haven't been willing to explore it enough intellectually. I think too many of us got stuck, and I count myself among this, in kind of the old Buffett Munger kind of mentality of, and by the way, they're buying oil, but like, and I have it on good word that Munger loved coal, by the way, like based on someone who met him before the end. So, compounders, everyone agreed the compounder looks like a certain thing.
Mm-hmm.
And that became the problem. Compounders don't have to be Constellation. They can look like other things. And so I think you should have to open your mind to it a bit and explore. And that's kind of what led me down that. That's a very long answer, but hopefully it gives you the idea of why we're in coal and also why they're compoundered me.
That was one of the more contrarian takes on a compounder I've ever heard. So thank you for providing that.
Perfect. It's a compounder podcast, so
I no one has ever pitched coal as a compounder, so I think that's a first. And I appreciate that. So we're basically out of time.
By the way, let me add one more thing to this too. So Whitehaven Coal, we own it. So disclosure there. It's not just buying back shares. And actually, I think they sold off recently because people wanted them to buy back shares. And they did an acquisition. Well, an acquisition of an existing asset doesn't add new supply to the market, right? Yeah. So that doesn't change that case. And in the end of the day, if you look at the acquisition they got handed the top, highest quality met coal on the face of the planet. They got handed it. One asset was 50 years, one was 16 years long. And they got handed it for somewhere between, 2 times earnings after tax for what, if you use met coal prices, which were high at the time and have come down a little since. And then if I use super bearish met coal prices way below where we're at right now, maybe they paid 5 times earnings. So let's say they paid 5 times earnings for these assets. You have people handing you a mine, 50 years of life left, and just saying, they're actually financing half of it too. They go, yeah, just give me the first 5 years earnings and you take the next 45. You're not expanding supply in the market. So it's not just buying back shares. It's like, there are companies in a position to compound capital by just picking up these orphaned assets.
Sure.
So I there are many angles to that one. So sorry I interrupted the question, but I didn't want to just suggest it was only buybacks. It's as long as coal is hated and you said, what's the sell discipline? What would make me change my mind on this? It's valuations. I mean, in the end of the day, I'll know the sentiment has changed when the valuations come back up. But in the end of the day, if I can put a, relatively bearish coal price assumption in there and sell it for 10 times earnings to someone else, which would be, probably, 3-4 times higher than some of these current prices I'm seeing. Yeah, I'll sell it there, and that's where I would sell it. I don't think that's going to happen for a while. I don't think these things are going to re-rate higher anytime sooner, and I love it because the sooner they re-rate, the less shares we wipe out. So actually, I highly recommend no one buys coal. I think it's a terrible investment.
And I think a lot of people will take that advice.
Yeah, I think so. They got a compound or a podcast. Probably I'm doing it.
So yeah, we've talked about a lot of different things. We've talked about portfolio construction. We've talked about commodities. We've talked about sell discipline. And so we'll close with a question that we always ask our manager guests. What is the most underappreciated aspect of the investment opportunity in front of PH Capital today?
So you're talking about kind of what we find most interesting in the market?
Or just like what, from a structural point of view, like what do you think is just the most, and maybe coal is that, and maybe you articulate that, but like from a more portfolio level perspective, what is the most interesting and underappreciated aspect of or area that you think people should be aware of?
Well, I think this is actually completely underappreciated right now. Is I think the macro backdrop, we're Americans and we're investing, we're measuring our returns in dollars, right? And so I think that the ongoing deficits that the US is pumping into the market, I think that, I mean, obviously last year with the bank failures and all that, and I could spend about an hour going into that, and I don't think that's the point of this question, but we've already seen the stress that can be called. But fundamentally, we're in a situation where, if you look at the entire history of the U.S. government, we were, by the end of 2022, we had, about 24 trillion of debt held by the public, which included probably about, there was what, 7, 8, 9, 7 or so on, I think on the central bank balance sheet. Probably another 7.5 trillion, I think at the time, was owned by basically foreign entities. And we had about 11 trillion owned by, basically domestic parties. Think banks, insurers, mutual funds, your money market funds, your, pensions, we basically have entered a point where if you look at foreigners aren't buying them on net. And central banks stopped buying them on net 10 years ago, but foreigners even include, your Japanese pension funds or this, like the demand's not currently there. Maybe it comes back, but it's not currently there and it hasn't been there. I mean, they're not increasing their holdings. And we have a central bank that says they're not going to buy. I don't buy that. I think they will. I think that's why the inflation risk is still very much alive. But right now they're saying they're not going to buy, and actually they say we're still going to sell, right? So if you have a U.S. government running 2 trillion deficits every year, central banks selling into that market allegedly, but just forget about them. Let's just say they stop selling, right? You're basically asking people who held 11 trillion of assets that they had accumulated since 1776. You're asking them to basically increase that by like 20% a year. The U.S. government thinks they can just pump those deficits onto their balance sheets, and you can't. You absolutely cannot do that, in my opinion. And I think once you realize that, the number of ramifications that leads you down the road of are remarkable. And I think the most fundamental one that should be in the back of everyone's mind is basically, and I'm not trying to be a doomer, whatever type here, but I mean, we're in a world that's more levered than it's been in the last century. I'm a avid fan of history, financial history, all that. I mean, I guess there's some parallels against post World War I era all the way up to World War II. We've never been this levered. And our solution has typically been, when we run into a problem, 08, 09, COVID. We just kick up more debt to the sovereign balance sheet. And I think we're running out of space to do that. And the way you get rid of an over leveraged system that is, I mean, you can have a bunch of defaults, which would send us into a Great Depression. I don't think that's the ideal solution. Or you inflate down the debts. Like, I think it becomes this isn't like an accident. I think it becomes a matter of US government policy to weaken the dollar, to help reindustrialize our economy, to inflate down our debts. And I think that you have to think about inflation risk and take it seriously. I think you have to think about how your holdings are going to respond to it. You know, and as you know, I mean, I think, historically, energy, it's really about your best hedge against inflation. And if that's the case, and it's the most undervalued asset in the market, you're kind of getting served up the opportunity of a generation. And so really that's the investment opportunity that we've been interested in for a couple of years. This isn't something I have no idea what the market's going to do tomorrow or next year or whatever. But if I had to do the old Buffett thing and buy something, stock market closes down for 10 years, I'd be pretty comfortable with, decent amount of coal, a little oil, little uranium, mixed in with my more classic kind of Polish software compounders and things like that we also own. So.
Well, Tom, I think this has been an incredible summary of all of the things that you look at. And, in a lot of ways, it's evidence of, the eclectic nature of your portfolio, but also like the number of things that you're willing to think about deeply and dive into and study. So I think people will get a really good sense of how you think through this. So thank you so much for being on the Compounders.
No, absolutely. Anytime. It was super fun. Thanks, man.
Tom mentioned a number of securities on this podcast. I don't own any of them.